Thank you, Sarah. Next, please. As this presentation is geared towards established doctors and dentists, most of you likely have a PC set up already. The diagram on the right that you see is the general organizational structure of a PC and probably looks familiar. In Ontario, shareholders of a medicine or dentistry PC can include the spouse, children, and parents. Let's start with a summary of the advantages of incorporating and how to use the corporation effectively under different scenarios, taking into account the federal tax changes from 2018. One of the main advantages of incorporation is to retain income and take advantage of the tax deferral benefits. Corporations have a lower tax rate than individuals. The small business rate on the first $500,000 of active taxable income is 12.2%. Taxable income in excess of $500,000 is taxed at the corporate general rate of 26.5%. For individuals, the marginal tax bracket for taxable income above $150,000 is 45%. And the tax rates continue to increase to almost 54% when taxable income is above $220,000. When you compare, you begin to see the large spread between corporate and personal tax rates. So if the professional income earned is not all required for personal and living expenses, by retaining the income in a corporation, you are getting the benefit of tax deferral. The corporation would pay less corporate tax than the amount of personal tax on the income that can be saved. There would be more after-tax income in the corporation to save and invest. And when you consider the growth potential of that savings compounded each year, it's clear why a corporate structure would be more optimal. In situations where practice is being started from ground up, or where a practice is being purchased, for example, a dental practice, the financing of the practice is more tax efficient if done through a corporate structure. Any financing would be repaid using after-tax corporate dollars. Based on the corporate tax rates versus personal tax rates, there would be more after-tax corporate dollars to repay the loan than after-tax personal dollars. Which brings us to the next point, liability. Operating a practice or business through a corporation provides a layer of security against personal liability and makes it more difficult for someone to go after personal assets if the business defaults on its debts, offering a level of protection against regular creditors. However, keep in mind, professional liability is not limited in any way by practicing within a PC. Corporations that were set up before 2018 also benefited from income splitting through payment of dividends to spouses, adult children, and parents who may have been shareholders. If the family member shareholder was 18 years or older, dividends could be paid to that shareholder, and that shareholder would pay tax on the dividend based on their marginal tax bracket. If the recipient shareholder was in a lower tax bracket than the doctor or dentist or had no other income, the personal tax would be significantly lower and combined personal tax for the family would be minimized. In 2018, the federal government changed the tax regulations, introducing tax on split income, or TOSI rules for short. The TOSI rules ensure dividends were taxed at the highest tax bracket to the recipient unless the recipient fell into one of the exceptions. With the new rules, advantages of income splitting became restricted, especially in situations where family member shareholder was not active in the business and also where family members are between the ages of 18 to 24, which is the target age group for children starting university or college. The TOSI rules do allow for income splitting in retirement. There is an exception rule for dividends paid to an inactive spouse when the physician or dentist is 65 years old or older. At that time, if the corporation were to pay dividends to the spouse, the dividend would be taxed at his or her marginal tax rate, not at the highest tax rate. In cases where the practice can be sold or the shares of the corporation can be sold, the corporate structure will allow for the use of the lifetime capital gains exemption. This is common planning for retiring dentists who can sell their practice. The lifetime capital gains exemption allows each individual shareholder who is selling their shares to shelter the first $883,000 of capital gains, so long as the shares are qualified small business corporation shares, or QSBC for short. The capital gains exemption amount is indexed each year, so it continues to increase. Since the lifetime capital gains exemption is available to each taxpayer, planning often included making the spouse, children, and parent shareholders of the corporation, so the capital gains exemptions can be multiplied. Be careful though, in order to claim the lifetime capital gains exemption, the shares would need to be QSBC shares. These are very exacting rules to qualify as QSBC shares. 1, the company must be controlled by Canadians. 2, it must be a private company, so not traded on a public stock exchange. 3, At the time of the sale of the shares, 90% of the fair market value of the assets of the company must be used in the active business carried on in Canada. So the practice, the medical practice or the dentistry practice. And for the last 24 months prior to the sale of shares, at least 50% of the fair market value of the assets must be used in the active business. So these asset value tests will prevent the corporation from building up excess cash or inactive investments. Which brings us to the next question, what to do? Next, please. Some methods to use the excess cash and to keep it from accumulating are 1, to pay down liabilities and debt. 2, use cash to purchase medical equipment, dental equipment, or other capital assets that are used for the practice, so active assets. Keep in mind that asset value test only looks at the value of the assets, not the net assets. So liabilities or debt of the corporation isn't considered. 3, consider payment of dividends to shareholders to use some of that cash. Be careful though, if dividends are paid to shareholders that would be considered TOSI dividends, they will be taxed at the highest tax rate. So plan around that if possible. However, as the practice continues to be profitable each year, only so much cash can be spent to prevent it from accumulating in the PC. At that time, a reorganization or restructuring should be considered where a new holdco is created. Next, please. This structure involves creating a new holdco where the surplus cash and profits of the PC can be transferred on a continual basis. This is done via share exchange. So in this diagram, the common shares held by a dentist is exchanged for new common shares and fixed value preferred shares equal to the amount that is targeted to be transferred. The preferred shares are transferred by the dentist to Holdco, and Holdco then issues preferred shares to the dentist for equal value in exchange. Now Holdco owns the preferred shares of the PC. The PC would immediately redeem the preferred shares from Holdco at the fixed value and transfer cash to Holdco for that redemption amount. So this is done annually to purify the PC to ensure it meets the asset value test to be a qualified small business corporation. It's also a strategy to protect assets and retain wealth by transferring excess cash out of the operating company that could be at a higher risk and building up the investments in Holdco instead. In this diagram, we've also included a discretionary family trust. So a discretionary family trust is put in place so income and property may be allocated to the beneficiaries of the trust. However, the beneficiaries do not directly own the shares of the Holdco. So this can be effective when you don't want children to own shares of Holdco directly or to prevent loss of assets and wealth when there is a marital breakdown. Next slide, please. Since the 2018 TOSI rules were introduced and the benefit of income splitting with a spouse who is not active in the corporation became restricted, planning for different structures to fall within one of the exception rules are being considered. In a recent technical interpretation, CRA commented on one of these reorganizations. In this case, the medical doctor's practice was transferred from PC number 1 to a new PC, PC number 2. The intention was that investment earnings from retained earnings from the medical practice in PC 1 could be paid out to the spouse without TOSI applying by using the excluded share exception. PC 1 had accumulated a substantial investment portfolio from prior years' retained profits. The spouse owned 50% of the common shares of PC 1 from the onset. The MD owned the other 50% of the common shares of PC 1. The MD also owned the voting shares of PC 1. However, now that the medical practice was transferred to PC number 2 and PC number 1 was no longer an active professional corporation, the spouse could own voting shares. So the MD sold 50% of the voting shares to his spouse. The medical practice continued under PC number 2. No funds were transferred at any time from PC number 2 to PC number 1. So at first, CRA opined that the excluded share exception would not be available because any dividend paid by PC 1 to the spouse would be considered to be derived directly or indirectly from a related business, i.e. the medical practice carried on by PC 2. One of the requirements for the excluded share exception is all or substantially all income of the corporation is to be derived from sources other than a related business, not carried on by the corporation for the last taxation year that ended at or before the time the dividend was paid. This means However, in April 2020, CRA revisited their comment and noted that if income is earned solely from its investment business, this income would not be considered to be derived directly or indirectly from the medical practice now carried on by PC number 2. And this would hold true even where the retained earnings from the medical practice in PC1 was used to earn that investment income. So CRA concluded that PC1 would in fact meet the criteria for the excluded share exception. This means that the second generation income in PC1, the income from the investment, could be paid to the spouse as a dividend, and it would meet the excluded share exception. CRA also did note that any transaction or series of transactions undertaken primarily to obtain the excluded amount exemption in a manner that would frustrate the object, spirit, and purpose of the TOSI rules, they would seek to apply GAR, which is a penalty provision of general anti-avoidance tax rules. Lastly, for those interested in real estate rental properties, consider incorporating a new sister code to hold that property. Regulations for a PC restrict rental property from operating within an active PC unless that property is used for the practice. Sister code will ensure the PC is not offside, and the PC is also able to loan money to sister code to help finance the purchase of that property. Next slide, please. Now I'm going to discuss the tax implications of separation or divorce. Next slide, please. So as Kim mentioned, on separation, the value of matrimonial assets is calculated, and the division of those assets need to be agreed upon by both parties to complete equalization. Shares of the PC would need to be valued. The fair market value of the tangible assets is determined. However, the value of the intangible assets, such as goodwill, patient lists, and charts, is also considered. So where a practice can be sold, there is considerably more value. The valuation will be reviewed thoroughly by your spouse's legal team, and they will likely challenge the value. It's important that the report be prepared by someone who is qualified and has a designation of CBV, Chartered Business Valuator, so that it will pass scrutiny. As part of the division of assets, shares of private companies may be more difficult to deal with because the value of the shares may be such that equalization can only be partially achieved by using other marital assets, and financing may be required to complete that equalization. Where spouses are shareholders of the PC, decisions will need to be made on what to do with the shares. Will the doctor or dentist buy back those shares from their spouse, or have the corporation redeem those shares? Or in a situation where both spouses are professionals and practicing together under one corporation, can the business or practice be split such that each spouse would continue to operate their practice separately? Next slide, please. In general, the Income Tax Act provides for the transfer of properties between related parties to occur at fair market value. However, where the transfer is between two Canadian resident spouses, Section 73 of the Income Tax Act requires the transfer to take place at cost, unless an election is filed for that transfer to take place at an amount other than cost. Section 73 will apply in the settlement of rights arising out of a marriage or common law partnership. This means on separation, this section provides for assets to be transferred between spouses on a tax-deferred basis, so that no capital gains is triggered on the transfer where assets are being moved as part of the settlement. It should be noted that 73 only applies while the parties are still married or living as common law partners. Under Canadian tax law, a spouse is a person to whom you are legally married. A marriage is ended only through legal divorce. So timing should always be considered, and more so in a common law partnership, where it's deemed to be terminated once partners have separated for 90 days or more. If assets are transferred at a later time when the divorce is finalized or after a common law union is considered terminated, this tax-deferred spousal rollover rule would no longer apply, potentially resulting in capital gains tax on the transfer. As part of the negotiation of the division of assets, it should be kept in mind that the recipient spouse will pay tax on any accrued gain when they ultimately dispose of the property. Depending on the circumstances, the parties may prefer not to have Section 73 apply and instead have the transfer take place at fair market value. For instance, it may be beneficial to transfer shares of a qualified small business corporation at fair market value to take advantage of the transfer's lifetime capital gains exemption. or intentionally realizing capital gains on the transfer of the property to allow the transfer to take advantage of unused capital gains or capital losses they may have accumulating. Section 73 is made on a property-by-property basis. So it's important that in the settlement agreement to clearly specify the properties to which the election will apply, even on a share-by-share basis. Transaction where such elections are filed will also increase the adjusted cost base of the particular property to the recipient. This can be beneficial, for example, to a dentist to receive a bump up on the adjusted cost base on the shares where they are able to sell the shares in the future. Next, please. In a situation where both spouses are professionals and operating their practice under the same corporation, dividing corporate assets using a butterfly transaction may be an option. This is basically splitting the assets of one corporation into two companies, one owned by each spouse, without incurring income taxes. There are generally two ways to achieve a butterfly transaction: the related party butterfly and the divisive butterfly. The difference between the two butterfly transactions hinges on the tax concepts of what we define as non-arm's length and arm's length. So to explain, under Canadian tax law, a spouse is a person to whom you are legally married. Marriage is ended only through legal divorce, regardless of the length or physical distance of the separation. This means that even if you have separated from your spouse for years and live on opposite ends of the country, you are not considered to be dealing at arm's length for tax purposes until a divorce is finalized. A related party butterfly only applies to non-arm's length parties. So this must be completed while the couple is still considered together for tax purposes. This approach is more flexible in that the couple can decide which assets are allocated to each of the two resulting companies they will separately own. A divisive butterfly applies when parties deal at arm's length. This approach is significantly less flexible and more complicated to do, as there are specific rules dictating that each company must receive pro rata shares of each business and non-business asset. Butterfly transactions are costly to implement and can take several months to complete. So the value and the size of the practice would need to be considered first to determine if this option should even be explored. Next, please. Normally, in situations where a corporation is buying your shares or those shares qualify for the capital gains exemption, you will have a capital gain, but claim your lifetime capital gains exemption, so no taxes will be triggered. However, when the purchasing company is non-arm's length and the redemption amount exceeds the paid up capital of the shares, the excess would be deemed a dividend and not a capital gain. Spouses are considered non-arm's length, as are the corporation they control. If a share redemption was being contemplated to buy back the shares and to complete the equalization, be aware there will be tax arising on the deemed dividend. Next slide, please. There are many approaches to consider in transferring property in the breakdown of a union. In this presentation, I only talked about the professional corporation and its shares. The plan to achieve the optimal outcome for both parties involved will look very different depending on whether one or both parties own shares, are active in daily operations, among other considerations. Other matrimonial assets and its tax implications will also need to be considered, such as the principal home, a family cottage, RSPs, RIFs, TFSA, and other personal assets. During a separation or divorce, tax is not always top of mind. In addition to consulting with your family law lawyer, it's important to consult your accountant prior to and during the separation process to ensure that you're maximizing tax savings and preserving your assets. That concludes my presentation. I provided my contact information on the next slide. Thank you.